Did you know that the total distress in United States commercial real estate has exceeded $116 billion, marking the highest level in over a decade? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. Recent data from Credit Weekly highlights a growing concern in the United States commercial real estate sector, particularly in multifamily properties and tenant leasing. The distress in commercial real estate credit has been escalating, driven by higher borrowing costs, the shift towards work-from-home models, and looming debt maturities. Researchers at Green Street have noted that while delinquencies continue to rise, the rate of increase has moderated. However, the overall distress level climbed by 23% to over $116 billion at the end of March compared to the previous year, according to MSCI Real Capital Analytics. The Federal Deposit Insurance Corporation reported that the past due and non-accrual rate for commercial real estate portfolios reached its highest point since 2014. This is particularly concerning for multifamily properties, which are increasingly seen as a source of financial strain. Past due and non-accrual loans are those so far past due that banks have stopped booking the interest owed because they doubt they will ever receive it. This policy uncertainty is holding back market activity as businesses delay decisions, as highlighted in the Federal Reserve's May Beige Book survey. In comparison, the situation in the Kitchener-Waterloo, London, and Cambridge areas of Ontario, Canada, presents a different picture. The commercial real estate market here remains relatively stable, although it is not immune to the broader trends affecting the industry globally. Canadian investors are watching the U.S. market closely, aware that these patterns could cross the border, especially concerning tenant leasing and multifamily properties. Interestingly, in the United States, the proposed Section 899 revenge tax in former President Donald Trump's tax and spending bill could potentially lead to wider foreign investor pullbacks, impacting all U.S. real estate lenders. Harsh Hemnani, a senior analyst at Green Street, suggests this could trigger further complications in the market. Moreover, Deutsche Pfandbriefbank AG, a German commercial property lender, announced its exit from the U.S. market, planning to wind down, securitize, or sell its €4.1 billion portfolio. This decision highlights the challenging conditions in the U.S. market, although the timing of their exit suggests a belief in a favorable window for divestment, amid improved liquidity and competition in the debt market. The Financial Stability Board recently cautioned that shadow lending to the commercial real estate industry may amplify and transmit shocks to banks globally. This concern extends to traditional lenders in the U.S., who are dealing with large unrealized losses on securities portfolios. According to the Mortgage Bankers Association, some credit providers have extended loan durations, contributing to the rising wall of commercial real estate debt. As we continue to monitor these developments, it's clear that the commercial real estate landscape is in a state of transformation. For investors and brokers alike, staying informed and adaptable is more crucial than ever. We'll continue to bring you the latest insights and analysis on these evolving trends. The rise of outdoor advertising is turning heads in the commercial real estate sector, as reported by ANI. As malls evolve into entertainment hubs and office complexes incorporate shops and cafes, this form of advertising is becoming increasingly valuable. No longer just an extra branding element, outdoor advertising is fast becoming a core vertical in commercial real estate business strategies, according to several industry executives. Outdoor advertising, or out-of-home advertising, reaches consumers while they are outside their homes. Real estate executives have noted that this advertising has transformed from basic static hoardings to a lucrative, value-added segment for commercial properties. Umang Jindal, Chief Executive Officer at Homeland Group, remarked that as commercial assets become mixed-use destinations, advertising is no longer peripheral, but a strategic component that adds value. Vijay Kamboj, founder of BrikeX Infra, pointed out that growing urbanization and increased pedestrian flow have turned buildings into potential media channels. Facades, rooftops, digital billboards, and transition points in commercial buildings are now strategically utilized for brand exposure, demonstrating the evolving landscape of commercial real estate. Data from Markantel, an Indian data intelligence firm, indicates that the digital out-of-home advertising market was valued at approximately 284 million United States dollars in 2024 and is projected to reach 620 million United States dollars by 2030. This growth underscores the increasing importance and revenue potential of outdoor advertising in commercial real estate. Executives note that advertising income typically represents 3 to 8% of a commercial building's revenues, but it can exceed 10% in marquee frontage and digitally enabled properties. Jihari Babu, national president of Naredco, stated that outdoor advertising in premium special economic zones or transit points can drive revenues as high as 12% or more, highlighting its critical role in enhancing revenue streams. In major Indian cities like Mumbai, Delhi, Bangalore, and Chennai, the demand for digital billboards, LED screens, interactive displays, and digital transit advertising is rising. Munir Ahmad, Vice President for Audio/Visual Business at ViewSonic India, observed that consumer preferences are shifting from traditional to digital platforms, with global real estate players investing more heavily than their Indian counterparts. Ashish Gupta, Director of Mandate Strategy at Anarock Group, emphasized that revenue potential is closely linked to location and foot traffic. Anarock Creative Agency targets high-traffic areas like Bandra Kurla Complex in Mumbai and Cyber Hub in Gurugram to maximize digital advertising spend for developer clients, showcasing the strategic approach to site selection. In Delhi, NCR, and Gurugram, there is strong demand for non-traditional advertising media, including facades, terrace edges, lobby screens, and elevator wraps. Advertisers are eager to utilize these eye-catching out-of-home locations to create experience-based brand interactions, according to BrickX Infra founder Vijay Kamboj. Experiential activations and pop-ups in amenity spaces are also gaining momentum, allowing brands to engage captive audiences within commercial buildings. In the rapidly evolving landscape of commercial real estate, the old ways of doing business are being challenged like never before. As market dynamics shift, tenant expectations evolve, and sustainability becomes non-negotiable, industry leaders are facing a critical question: adapt or become obsolete. For Nick Milliken, Chief Executive Officer of Greycoat Real Estate, the answer is clear. A lot of people now have a much better view about what they need, Milliken explains, cutting to the heart of the market's transformation. It's becoming a two-tier market. There are good buildings in desirable locations with modern environmental performance that are doing very well, and rents are actually going up. Then there are properties that aren't really fit for purpose and are in the wrong location that probably need to be repurposed into something else. This bifurcation of the market isn't just Milliken's observation, it's the foundation of Greycoat's strategic approach under his leadership. While some competitors have retreated from the office market altogether, convinced that remote work would make physical workplaces obsolete, Milliken recognized that the office wasn't dying, it was evolving. This insight has positioned Greycoat to capitalize on a future where quality, sustainability, and location are the non-negotiable trinity of successful commercial properties. The numbers tell a compelling story. Sustainable buildings in London command an average green premium of 11.6% in rents compared to traditional properties. This isn't just a reflection of tenant preferences. It's an acknowledgement that energy-efficient, low-carbon buildings deliver tangible financial benefits by reducing operational costs and aligning with corporate sustainability goals. Milliken saw this shift coming before many of his peers. I think there's more of a need to invest in buildings now than there has been historically because of the environmental regulations here changing. And so people are kind of forced to make their buildings more energy efficient, he observes, highlighting the intersection of regulatory pressure and market opportunity. For Greycoat, sustainability isn't a checkbox to be ticked. It's the cornerstone of their entire business strategy. Under Milliken's leadership, the company has developed a comprehensive framework with clear benchmarks like EPCA ratings and BREEAM Excellent certifications. Every development decision passes through this lens, with carbon budgets receiving the same rigorous scrutiny as financial analyses. This approach positions Greycoat perfectly for a future where, according to industry research, the demand for low-carbon office space in London is expected to exceed supply by 35% by 2030. With over 7,600 companies committing to science-based carbon reduction targets in recent years, the market is speaking clearly. Sustainability is no longer optional. When Milliken joined Greycoat in 2012, he didn't just maintain the status quo, he orchestrated a fundamental transformation of the business model. Recognizing the limitations of operating solely as a consultancy, he pivoted toward an operating partner approach, where Greycoat collaborates with larger investment groups to acquire and develop properties. The results speak for themselves. Under Milliken's leadership, Greycoat reached a peak assets under management of £2.5 billion by late 2018 to 2019. In a move that seems prescient in retrospect, the company sold most of these properties just before the COVID-19 pandemic, what Milliken modestly describes as more through luck than judgment, but which positioned the company remarkably well for the disruption that followed. This partnership-based strategy continues to yield results. The December 2023 acquisition of 20 Finsbury Dials with Goldman Sachs Asset Management exemplifies Milliken's approach. This 140,000 square foot office building isn't just being refurbished, it's being completely reimagined as an eco-friendly, amenity-rich workspace designed to attract high-end tenants for long-term profitability. The development aims to achieve BREEAM Outstanding, EPC-A, and WELL Platinum ratings, signaling Greycoat's commitment to setting new benchmarks in sustainable building practices. By 2030, Generation Z will comprise about 30% of the global workforce, bringing with them expectations that fundamentally challenge traditional approaches to commercial real estate. Raised in an era of smartphones, instant information, and heightened environmental awareness, this cohort demands flexibility, purpose, and integrated technology in their work environments. Milliken has positioned Greycoat ahead of this demographic shift. People are actively considering how to persuade employees to make the commute, he notes, recognizing that in a world of remote work options, offices must offer compelling value beyond just a desk. Under Milliken's guidance, Greycoat's developments incorporate features like rooftop terraces, landscaped areas, and communal spaces that foster community and creativity, elements that cannot be replicated in a home office environment. This approach acknowledges a fundamental truth. Employees will commute if the destination offers genuine value, access to amenities, collaboration opportunities, and spaces that enhance well-being. While some industry players have retreated in the face of inflation and high interest rates, Milliken sees the current market conditions as rich with opportunity. His perspective is both psychological and strategic. I think long-term investment is as much about sentiment as anything else, he observes. I think the big impact will be when the central banks start to cut rates. People will be able to say to themselves, well, the worst is over. Things are going to get better from now on. I think that will encourage them to get back into the market and purchase assets again from a psychological perspective, rather than because the maths has really changed that much. This insight has informed Greycoat's recent investment strategy. In 2021, the company raised a fund to enable more substantial co-investments alongside majority investors and began reinvesting at the end of that year. With fewer competitors in the market and asset prices at potentially undervalued levels, Milliken sees an opportunity to acquire properties with significant potential. I think at the moment, we feel that sentiments have led to an overcorrection of office prices in some areas, and with some criteria building. So some stuff is probably cheaper than it should be if you take a medium-term context, and so we're quite keen to take on new projects. Under Milliken's leadership, Greycoat has successfully taken its proven strategy beyond the borders of the United Kingdom with the launch of Greycoat Real Estate LLP France. This milestone marks the company's first expansion outside its home market and reflects Milliken's strategic vision for European growth. The launch was spearheaded by the appointment of Arnaud Malbos as senior real estate partner, who brings extensive pan-European investment expertise from his previous role at Ivanhoe Cambridge, part of the real estate group CDPQ. Arnaud's deep knowledge of the real estate market and his track record in implementing successful investment strategies will greatly enhance our capabilities at Greycoat, said Milliken. In his new role, Malbos is responsible for sourcing and evaluating investment opportunities in France, developing strategic initiatives, and leading key projects that align with Greycoat's growth objectives. This European expansion demonstrates Milliken's confidence in Greycoat's business model and its adaptability to different markets. By applying the company's expertise in sustainable development and market-responsive design to new geographies, Milliken is positioning Greycoat for continued growth and influence across the European commercial real estate sector. As the commercial real estate industry grapples with post-pandemic realities, environmental imperatives, and shifting tenant expectations, Nick Milliken's leadership at Greycoat offers a masterclass in navigating change. His approach combines strategic foresight with tactical agility, recognizing long-term trends while capitalizing on immediate market opportunities. By embracing sustainability as a core business strategy, forming powerful strategic partnerships, designing for a new generation of workers, and maintaining adaptability in uncertain markets, Milliken has positioned Greycoat at the forefront of the industry's transformation. In a significant move within the greater Cincinnati market, a Michigan-based commercial real estate firm, Schostak Brothers Company, has acquired a 21-acre industrial site in Harrison, Ohio. This site is fully occupied by subsidiaries of Warren Buffett's Berkshire Hathaway, signaling a noteworthy transaction in the industrial real estate sector. The property, located at 100 Production Drive, was purchased for $9 million, a substantial increase from its last sale in 2010 for $2.3 million. This industrial property features a 308,880 square foot building equipped with 29 dock doors, catering to various industrial needs. The site, which also includes surrounding surface parking lots, demonstrates the sustained interest and investment in industrial real estate, especially for properties with established tenants like Berkshire Hathaway subsidiaries. The acquisition by Schostak Brothers Company underscores the firm's strategic entry into the Cincinnati market, reflecting broader trends of investment in industrial spaces. As industrial real estate continues to attract investors, this transaction highlights the potential for growth and opportunity within the sector, particularly in regions like Cincinnati that offer robust infrastructure and connectivity. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.